Hi there. I had to start investing today from scratch, knowing what I know about Nvidia, AI, and the next strange layer of computing being built underneath all of it. I would not treat quantum computing like a normal stock trend. Most people hear the word quantum and immediately think it is too early, too confusing, too academic, or just another market story designed to separate excited investors from their cash. And honestly, for a long time, that reaction was probably fair. The machines were fragile. The revenue was tiny. The customers were mostly governments, labs, and giant companies doing experiments. But when the companies building the AI economy start building bridges into quantum, you have to pay attention. We may be watching the first real shift from quantum as a science project to quantum as an investable computing layer. Today is Tuesday, April 28th in New York. Comment below what day and date you're watching from, because timing really matters on this one. And if you value this kind of work, support the channel by subscribing and commenting John A.G. Best. It tells me you want original research, not recycled hype. So in this video, we're going to walk through exactly what changed, why Nvidia suddenly matters in quantum, and how I would think about IonQ, Rigetti, and D-Wave if I was starting from zero right now. Not as a guaranteed win, not as some magic ticket, but as a dangerous, early, very real technology race. And by the end, you'll understand why this may be bigger than just another AI stock story. So let's get started. The first thing you have to understand is that the market loves simple stories. Smartphones created Apple wealth. AI created Nvidia wealth. So people naturally ask, what creates the next wave? And that's where quantum comes in. Now, I'm not saying quantum is the next Nvidia tomorrow morning. Please don't hear that and go do something silly. These companies are still small. They still lose money. Their stocks can move violently because expectations are doing more work than earnings. But early platform shifts always look messy before they look obvious. That is the game. The turning point started with a comment that hurt the whole sector. Nvidia's CEO said useful quantum computers were still many years away. Not next quarter, not around the corner. More like a long road with a lot of engineering still ahead. And the market reacted like someone turned off the lights. IonQ dropped hard. Rigetti got hit hard. D-Wave got hit hard. The entire group reminded investors that one sentence from the right person can move young technology stocks more than a balance sheet can. But here is the important part. The story did not stop there. After that, Nvidia started acting like quantum was not some sideshow. It announced the first quantum day at GTC. It pushed CUDA-Q, an open-source platform for hybrid quantum classical work. It introduced NVQLink, a system meant to connect quantum hardware with accelerated computing so researchers can work on calibration, control, and error correction faster. That is not a small signal. Nvidia is not saying quantum replaces GPUs. It is saying quantum may need GPUs. That's a totally different idea. If quantum becomes real, it probably does not sit alone in a glass box somewhere. It plugs into data centers. It talks to CPUs. It talks to GPUs. It uses classical machines to control fragile quantum systems in real time. That means the future may not be AI versus quantum. It may be AI plus quantum plus accelerated computing, all working together. That is why I think Nvidia matters here. Not because Nvidia is suddenly the best pure quantum stock, it isn't, but because Nvidia is building the roads. And in technology, road builders can become very powerful. Now let's talk about the three names everyone wants to argue about: IonQ, Rigetti, D-Wave. They are not the same company. They are three different bets on what quantum computing actually becomes. IonQ is the trapped ion and networking bet. It uses charged atoms as qubits and controls them with lasers and electromagnetic fields. In simple English, that means IonQ is trying to build high-quality qubits first, then scale by linking systems together. And this is where the recent update matters. IonQ demonstrated a photonic connection between separate trapped ion quantum systems and was selected for DARPA's HARQ program, which is focused on heterogeneous quantum architectures and interconnects. That sounds like technical soup, but the idea is simple. If one quantum processor is not enough, you need a way to connect more than one. That is the scaling problem. A single chip can impress people. A connected system can become an industry. IonQ also has something many quantum names do not have yet: meaningful revenue for the category. According to its latest annual results, IonQ reported about $130 million in annual revenue, more than triple the prior year, and ended the year with around $3.3 billion in cash and investments. It also guided for roughly the low 200s of millions in revenue this year, with backlog in the high 300s of millions. Now those numbers are still tiny next to Nvidia. Tiny, but compared with the rest of public quantum hardware, IonQ looks more developed. That is why investors treat it like the frontrunner. But there is a catch. IonQ is still not a normal profitable business. Some accounting gains can make the bottom line look better than the operating reality. So don't just look at a headline profit and think the company is printing money. It is still building, it is still spending, it is still proving the model. Then there is Rigetti. Rigetti is the superconducting bet. This is the style of quantum computing that uses tiny circuits cooled to extremely low temperatures. It is closer to the approach many large technology labs have worked on, and it has one clear attraction: speed. But speed is not enough. If the qubits are noisy, if errors pile up, if the system cannot scale cleanly, then raw speed can become a fancy problem instead of a solution. That is why Rigetti is high risk. It has exciting technology, but the commercial base is still very small. The fresh development is that Rigetti made its 100-plus qubit Cepheus system available through Amazon Bracket, giving customers and researchers cloud access instead of forcing them to own the hardware. That is important because early adoption usually happens through access. Developers want to test, universities want to experiment, enterprises want to see if there is a real use case before writing a massive check. Rigetti's latest annual revenue was only around $7 million, and it had close to $600 million in cash and investments at year-end. So the story is not current sales. The story is runway and milestones. Can it improve fidelity? Can it keep customers testing? Can it integrate into hybrid workflows? Can it become useful before investors lose patience? That is the whole question. Then you have D-Wave. D-Wave is different because it already leans into commercial quantum annealing. That is not the same thing as a broad universal quantum computer. It is more specialized. It focuses on optimization problems, things like scheduling, routing, resource allocation, and finding better answers across huge possibility sets. Some investors dismiss that because it is narrower. I think that is too simple. Narrow can be a weakness, but narrow can also be how you get paid first. D-Wave has customers using its systems today, and its latest full-year revenue was around the mid-20s of millions, up sharply from the year before. It also reported strong early-year bookings and completed the acquisition of Quantum Circuits, giving it a second path through gate model quantum technology. That second path matters. D-Wave is basically saying we have a practical, commercial system now, and we also want exposure to the broader gate-based future. That gives it optionality. But optionality does not remove risk. D-Wave's revenue can be lumpy. Big bookings can make a quarter look amazing. Then silence can make the next period look weak. And because these companies are still small, sentiment can dominate everything. Here's the part that I think most people are missing. Quantum is not trying to do every calculation better. That is the wrong mental model. You do not need a quantum computer to run email, stream a movie, or build a normal AI chatbot. Classical computing is incredible at ordinary work. GPUs are incredible at parallel AI work. Quantum is different. It is built for a smaller set of problems where the search space explodes so quickly that even massive classical systems struggle. That matters for investing because it keeps the hype under control. If someone tells you quantum replaces everything, they probably do not understand the business. If someone tells you quantum replaces nothing, they may be missing the specialty use cases that could become extremely valuable. Think about it like this. A jet engine does not replace a pickup truck, but if you need to cross an ocean quickly, the jet engine changes the entire game. That is how I view quantum. The commercial path probably starts narrow. One optimization customer here, one chemistry simulation there, one government contract, one cloud workload, one cryptography preparation project. Then, if the hardware improves and the software gets easier, the use cases expand. That is usually how deep technology becomes normal. First, it looks useless to almost everyone. Then it becomes useful to a small group with very expensive problems. Then the tools improve, the cost comes down, and suddenly people forget they ever called it impossible. AI had a version of that. Cloud computing had a version of that. Even semiconductors had a version of that. The early phase is confusing because the market wants clean proof before the proof is clean. But investors do not get clean proof and early prices at the same time. That is the trade-off. So with quantum, I would not ask who has the prettiest press release. I would ask who can survive long enough to make the engineering boring. Because boring is the milestone. When a quantum workload becomes repeatable, accessible through the cloud, understandable for developers, and attached to a customer budget, that is when the story becomes less speculative. And we are not fully there yet. But we are closer than we were a year ago, and that is why earnings will matter so much right now. Not because one quarter solves quantum, but because each report tells us whether these companies are converting attention into contracts, contracts into revenue, and revenue into a business model that can last long enough for the science to eventually catch up commercially too. So what is the actual investment framework? Here's how I would think about it. IonQ is the cleaner leader if you want revenue, backlog, cash, and a scaling story. Rigetti is the high-risk cloud and superconducting bet, with potentially large upside if the Nvidia-style hybrid future becomes the standard. D-Wave is the practical commercialization and optionality bet, with paying customers today and a broader architecture story after its acquisition. If I had to choose one, I would lean IonQ. Not because it is safe. It is not safe. But because it has the strongest mix of commercial progress, balance sheet strength, and technical narrative. But if I was building a small speculative basket, I would not pretend I can perfectly pick the winning architecture. Nobody can. This is the part investors hate admitting. The best technology does not always win first. The best funded survivor sometimes wins. The best ecosystem sometimes wins. Sometimes the company with the most boring customer adoption becomes the one everybody underestimated. That is why sizing matters. This is not emergency fund money. This is not rent money. This is not the money you need to pay taxes or sleep at night. Quantum stocks can rise fast and fall faster. If you cannot handle a brutal drawdown, you probably should not be here. And if you're successful, share your success story in the comments so others can stay motivated. Now, the skeptical view is also important. Quantum may remain early for longer than bulls expect. Fault-tolerant systems may take years. Commercial use cases may grow slower than market caps. Government budgets can change. Dilution can happen. And a company can be technically impressive while still being a bad stock at the wrong price. That is the uncomfortable truth. But ignoring the sector completely may also be a mistake. According to recent market forecasts, quantum computing could grow from a small billion-dollar scale market into a much larger industry over the next decade. Estimates vary widely, which tells you how uncertain this is, but the direction is clear. More money is coming into quantum infrastructure, more governments care about it, and more large companies are preparing for a post-quantum world. The reason is not hype alone. Quantum could eventually matter for drug discovery, materials science, logistics, batteries, cybersecurity, finance, and advanced simulation. Not every workload, not your spreadsheet, not your favorite app. But certain problems where probability, optimization, and simulation become impossibly hard for normal computers. That is where quantum earns its place. So the setup is this. Nvidia is building the connective tissue. IonQ is trying to scale trapped ion systems. Rigetti is putting superconducting hardware into the cloud. D-Wave is monetizing specialized optimization and adding a second architecture. This is no longer just a science fiction conversation, but it is also not a guaranteed goldmine. The winners will be the companies that turn fragile lab machines into reliable infrastructure. That means better error correction, better interconnects, better software, more repeat customers, and enough cash to survive while the technology matures. That is what I'll be watching. Not just hype, not just stock charts, not just one CEO quote. I want to see whether revenue keeps growing, whether backlog turns into real sales, whether cloud access creates actual usage, and whether customers come back after the first experiment. That is when the story changes. So yes, I think quantum deserves a place on the watch list, maybe even a small place in a high-risk portfolio. But only with the right expectations. This is a long road. There will be fake breakouts. There will be ugly sell-offs. There will be headlines that make people euphoric and headlines that make people panic. That's normal. The point is not to chase every spike. The point is to understand the platform before it becomes obvious. Because the biggest wealth in technology often gets created in the gap between this is impossible and everybody uses it. That gap may be opening now. And just to be clear, this is for education and research only. I'm sharing how I'm thinking through the opportunity, not telling you what to buy or sell. Do your own work, understand the risks, and make decisions that fit your own financial life.